What lessons do we pick from the Kenya's upcoming Treasury bond switch auction that is taking place in March and April? So this week, the Central Bank of Kenya announced and published a prospectus for the switch of one Treasury bond that is maturing um, in less than like 6 months, for those who are holding that Treasury bond to switch to a medium term bond that is maturing in 7 years from now. One interesting aspect is that the bond they are switching from was issued in 2016. It has a 10% uh, withholding tax, and its coupon rate right now is 15%. And the destination bond was issued in 2018. It has a 10% withholding tax, but it has a lower coupon rate of 12.65%. So, one, the government is replacing a bond with a higher coupon rate with one for a lower coupon rate. So, for those people in Kenya who hold the current treasury bond with uh, which is about to mature, can switch into a longer term, a medium term treasury bond. But most importantly is the lessons which we pick up when it comes to such bond switches. Now, when I did my research, that bond switch is the one, the bond which is about to mature. The government of Kenya, or the Central Bank of Kenya, has issued close to 100 billion Kenya shillings in the treasury bond, in that bond, which is maturing in less than a half a year, in like 3 months from now. However, most importantly, that's a lot of money. So when you are managing liquidity, and especially when you are at a time like where the Kenyan market is, where at the time where the treasury bonds are at of lower rate, instead of allowing the bond to mature and you pay that money off, you give the bondholders to switch to another bond at their own quoted yield, and then you allow them to, without you paying them off. And we have seen it. For those of you who are in Uganda, we last saw a bond switch in 2023. We have not seen a bond switch anytime soon. But I know as we enter into 2027, 2028, where we shall be seeing significant amount of treasury bonds that will be maturing, we might end up seeing a few switches. The switches sometimes happen when there is a treasury bond that is maturing, that is of significant value, that the government, instead of paying money, it allows people to switch from one bond to the other. Now, one thing that I noted is the bond that is maturing, it has 100 billion in Kenya shillings. For those of you who are in Uganda, that is close to 3 trillion UGX. However, the government is only offering around 20 billion in switches. That means, I know at one point people can take, depending on how many people or how many institutions and how many investors might end up accepting the switch. It might be one of those biggest switches that all of it, or 80% of it, getting extended. So the fact that the government, instead of the most important element of switches is not the government inability to pay, but it's the government ability to take advantage of what the market is. If there is significant appetite in the market and there is significant liquidity in the market in the fixed income products, instead of them paying and then bringing up a new bond which will then create a new issuance and a new system, they just move whatever is maturing in a bond into existing bonds. In one important element there is that people can quote it. Now in Kenya, you can quote whatever bond you want and you come up with your own price when it comes to yield to maturity. Then they can either accept or reject it depending if it's a competitive bid or a non-competitive bid. But that tells you, as we go into majority of these as we go through in many of these countries, as they start getting maturity, for those of us who track the treasury bond market in Uganda, everywhere, you're going to start seeing more and more switches from a maturing bond to a long-term bond, from the expensive high coupon rate bonds to a lower coupon rate bonds. As you can see, the bond that they have, they are switching from has a 15% coupon rate. They are switching to one which has a 12.65% coupon rate. From a cash flow perspective, that is much better. It's much better because you might switch at the same face value, however much you might get a higher face value because of discounting and the related kind of elements to a much better deal. You can see the bond they are switching from is the data price right now. It's at trading at 4.7% um, premium, which is close to 5% premium. So for people who hold this bond right now, might be better off to switch from this bond, the bond which goes until 30 2033. When I looked at that bond, the 20 that bond, it's it also they have so far issued close to 120 billion, so they are switching from 100 billion bond in Kenya shillings to 120 billion. Now it makes sense why they are trying to only offer around 20 billion in a switch. But at least what you see, to the government, they are extending the liquidity payment challenge from currently to 2033. So instead of paying the money now right now to create a liquidity crisis, they just going to use the market that has appetite right now and switch the money to 2033.